Now I will proceed with group accounts, but it's time to go to the associates part, right? We said that, the group is between the parent and its subsidiary, right?
Yes.
Again, the group is between the parent and its what? Subsidiaries. And
Subsidiaries.
an associate is not part of a group, right? Because
Yes.
have, a company named as a parent does not have control over the what? Over the associate. You just have the significant influence. So,
Significant.
how do we account for associates? At the very beginning, we spoke of what an associate is. It means the
I
company
don't know if you are talking to be you sound like to be talking from very far from the laptop.
looks like that. Hello. Uh-huh. Oh,
Hello?
okay. What I'm saying is,
Yes, now you're okay.
okay, what I'm saying is, when we speak of accounting for associates, I think now you know what an associate is, right?
Yes, sir.
An entity that another entity has a significant influence over it. Not control, but just significant what? Influence.
Influence.
And usually we consider 20% to 50% inclusive. If you are owning shares in this range, you would say, okay, you have a significant influence, and you can say that
Influence.
that company is an associate to you. So if
Yes,
A,
sir.
if A, for example, owns 25% in B, it means B is an associate of A, right? A
Yes, sir.
considers B as an associate. So when A consolidates its subsidiaries, it would not consolidate B, right? But it will just deal with
Yes.
something. So what do we do? Associates are not consolidated because the parent does not have control of them on them. Instead, we account for them using the equity what? Method. It's simple.
Equity
When we
method.
speak of the word equity, it means we only touch equity. Do not touch assets, do not touch liabilities. Just like that. You see how simple it is?
Okay.
Yes, you
Okay.
do not touch its assets. Do not touch the assets of an associate. Right? Let's
Okay.
deal with the equity component. As simple as that. When you have the subsidiary, okay, you take the assets, you add the assets together, you add the liabilities. No, we don't do that for an associate. Right?
Okay.
We only deal with the equity component. So you can get the picture. And you can also
Yes,
remember,
sir.
right? Remember, when you, when,
Yes.
when we are consolidating the subsidiary, we said that first of all, you compute goodwill. And by computing goodwill, you remove the investment cost, you replace by goodwill. And you remove the net assets, you replace by NCI. In this case, we are not going to do that, right?
Okay. Yes, sir.
Yes. So we want to remove any investment cost. If the investment cost was there, we'll just just look for the way to just to change it to a new figure by adding the equity component, just like the equity method says. Right.
Okay.
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 So this is what we usually do. It's very simple. The equity method is very simple. As per ICE 28, it said that the carrying amount should be determined as follows. First of all, in the books, you would have invested your figure. Let's say that it maybe 100 million, for example. That's why you write here cost. Of course, this would be already in your figure. It's just like the purchase consideration I told you. Do you remember the first question of purchase consideration? We said maybe you acquire
Yes, sir.
through share exchange, through deferred consideration, whatever method you would have used. Although for associates, usually we use cash usually, but I can't say that it should only be that way, right? So that's why you already have
Okay.
the figure. This figure of cost would probably be already in the books, right?
Okay.
Yes,
Yes, sir.
and we'll tell you, of course. Now, whatever remains, you take P's percentage of post-acquisition what? Reserves.
Reserves.
P's percentage of post-acquisition reserves. And this one is very clear. Let me go to working number 2. Although working number 2 is for a subsidiary, but we can get a complete picture. Which is a subsidiary, not an associate. But we are speaking of post-acquisition reserves, right? And the post-acquisition,
Yes.
like I told you, you take the total at the reporting date minus at the acquisition what?
Great.
Date. So after getting that difference, you look maybe if you are owning 25%, you take 25% of that figure and go on and place it on what? On the investment on what? And associate it is this one. You see this P's percentage of post-acquisition what? Reserves.
Reserves.
It's positive, you add it, it's a loss, you reduce it. Okay, the point here is we need to make the double entry. Where does the other entry go? Right. That's why you called it equity accounting. You take it to the group equity. So it directly goes to the group what? Equity or the group what?
Equity.
Reserves. Yes. So you add it here or deduct it here. If it's a loss, and also go to the group equity. You see the group equity or group reserves, it's here. You can find it and you could see it here. You see, P is the share of post
Okay.
retained earnings in the associates net of dividends. Of course, whatever you just say post acquisition reserves. Post acquisition what?
Reserves.
You just say reserves. Because you know when we are speaking of this, actually we won't need to separate maybe this is retained earnings or not or what, right? We'll just put everything there. Right. So it's simple.
Okay.
Whenever you're dealing, you can get the point now. Whenever you're dealing with an associate, whatever you change in the investment in your associate, you also go and change in what? In the group reserves. Just
In
like
the group reverse. Yes.
look here, impairment losses. You know, an associate could also have impairment, but not impairment is usually specified in the exam, right? Normal most of times.
Okay.
Of course, even if they don't specify it, it won't have a complication. So an impairment loss would always reduce the investment in the associates. So that's why it reduces here. You see,
Okay.
whenever you see it here, you also expect to see it where? The group reserves.
And the group reserves.
The impairment loss of an investment in the associate. You see it here?
Yes.
Of course, it's an impairment, yeah? Should be deducted. I just didn't put the deduction sign. Right.
Okay.
So it's just that way. And I would learn that when you are dealing with the associate, the impairment loss should not be, you should not take the percent. Do you see here? Here we take here, we have the P percentage of post-acquisition, but for impairment, no percent. You know why? If you have gone to an associate and maybe you have purchased 25%, it means that 25% is already reflected. So whenever you get the impairment loss, it's not like you're going to break it down just like what you do for the subsidiary. The subsidiary, its net asset 100%. So you break it down, right? But for an associate, you should never take the what? The percentage.
The percentage.
Yes, when dealing with the impairment loss. So you take note of that.
Okay.
Maybe another adjustment we say here, P's percentage of unrealized profit if P is the seller. Of course, like I told you, we are going to learn about this unrealized what? Unrealized profits. It's the same thing which I do explain before. You could also have an unrealized profit if parent is the seller. Okay, you don't have to memorize these ones, you know. I'm going to maybe help you understand why we do all this, right? Going to learn on this. And
Okay.
that's what would follow, would see this. So whenever
Okay.
you, like I told you, if you have it here, you would also have it in the group reserves. And then maybe you could have P's percentage of excess depreciation. Even for this excess depreciation, we would also understand it because, you know, when you have excess depreciation, right, and it reduces the investment cost, it means it would also go and reduce the equity of the what? Of the parent, but you would also see this. So it's no big deal. You're going to get everything. So the line
Okay.
item in the book should be investment in what? In associate.
An associate.
Yes. And maybe what do you do when you have the statement of profit or loss? Okay, you have not reached here, but it's no big deal. You can just look at it, you know, it's not that much of a big deal. It's obviously the same thing, right? Statement of profit or loss. Presume that you are preparing the statement of profit or loss for the books, right? Or the parent.
Yes.
You're also going to do the items in the income what statement. Of course, I think
Statement.
as of now, there is no so much need to deal with it. You can see it's almost the same things. Impairment loss and the profit, but I think let it be first. because
Okay.
that is the statement of financial position. Yes.
Okay.
We could also have, maybe we have the further adjustments here, you see. You can have the further adjustment, maybe you have the dividends, dividend received from the associate. You know, you are owning 30% in a company and they pay dividends, right? It means
Yes.
they will take 30% of that dividend and pay to you. So you and the parent, you and the company, of course, you would receive those dividends as income. They would be like the dividend income. How are you going to treat them, right?
Yes.
And so dividend received from the associate must be removed from the consolidated statement of profit or what? Or loss. So we're going to remove
Loss.
those intra-group items. If you're going to remove it from the statement of profit or loss, it means anything that goes to profit or loss, it would go to retained earnings. So you'd also remove it from the group what? Group equity. And
Okay.
transactions and balances between the associate and the parent company are not eliminated. So we do not eliminate the what? The transaction and the balances between the two, because the associate is not part of the group. Of course, you know, you can't say you have eliminated something, you have removed the intra-group balances, right? You can't say
Yes.
you eliminated the intra-group balance while actually you haven't added the figures. You haven't added the assets together, the liabilities together. Even if you want to remove, what are you going to remove? You're not going to remove
It's
anything, right?
complicated.
Yes.
Yes.
It will just be the normal adjustments, but not these transactions and the balances.
Okay.
You can see the group share. So we're not dealing with the transaction and the balances, but we can still remove the unrealized profit, just like between the parent and the what? And the subsidiary. And this is what they are trying.
Okay.
And that's why I told you up there that just just leave it first. You see, when we are speaking of this percentage of unrealized what? Profit. That's why I told you, okay,
Profit.
just leave that alone. You know, this consolidation, there are nice explanations here, but there is no big point just noting down one after another. I don't see a big point doing that. But
Okay.
I think it's time that we try to understand this provision for unrealized profit. I think it's the right time. Now, before going to this associate issue, let's just go back. Let's go back here. Yes. Let's try to do something, right? Now let's discuss.
Okay.
It's like you are trying to discuss. Let's discuss here the provision for unrealized what? Provision for unrealized.
Profit.
Yes. Now I won't deal with the associate with an associate directly. I would speak between the parent and what? And the
And
subsidiary.
the associate. Okay.
Yeah, let's start between parent one and what? And subsidiary. Okay.
Subsidiary.
Part one, presume that the parent sells what? The subsidiary. Right. And the part two
Yes.
would say that okay, subsidiary is what? Subsidiary sells to a what? To a parent.
To a parent.
You just need to understand, okay, so this is usually the case, put to normal. Okay, let's start. Parent sells to a subsidiary.
Now you've gone.
Hello?
Now, yes. Now I can hear you.
Saying this, a parent has sold goods to a subsidiary. It means a parent has a profit and subsidiary has the goods. Is it wrong?
Yes, sir.
I'm repeating
That's how it is.
parent has sold goods to subsidiary. The parent has the profit and subsidiary has the what? The goods.
The goods.
So what we are trying to do is, since it is a provision for unrealized profit, first of all, there is a way of getting it. Of course, getting it is simple. Presume maybe the parent sold good to a subsidiary and maybe had a profit of 50 or 500, right?
Yes.
But you are told that 40% of the goods are still with the subsidiary. So it means they are still not out of the group. You see that?
Okay.
So you have to remove whatever profit that is not outside of the what, that is still in the what? In the group. So
The group.
if you have sold 40% and the 60% have remained, you would ask yourself, okay, what amount of profit has remained? I would say 60 per what? Percent
Percent.
times 500, and I would get 300. You see that this will be my provision for unrealized what? Profit. So that's
Profit.
compute it, a sample of how to compute it. That's just a sample to see more and more, right?
Okay.
But now we just need the double entries here. So you have to know who got the profit and who got the asset, which is the inventory. So
Okay.
parent got the profit. So I need to
Profit.
profit from the parent, right? So
Okay.
I need to remove the inventory from the what? The subsidiary. So I would credit inventory. I would credit what?
Inventory.
The subsidiary by how much? 300, right? And
Yes.
I would go and remove the profit from the parent. From the what? From the parent. So if I'm preparing the income statement, I would say debit cost of what? Of sales.
Of sales.
Bear in mind that this all goes to the what? To the parent. And that's why, I told you that when you're preparing the income statement at the end, you would have to know what is attributable to the parent interest and what to the non-controlling interest. So when you are going to attribute that, you would know that, okay, all of this provision for unrealized the profit is related to the parent, not the what? The subsidiary. But listen, here we are speaking, we focus on the statement of financial position, right? So
Yes.
whatever goes to income statement would also go to statement of financial what? Position.
Mm.
So if
Okay.
if we debited the cost of sales, and the cost of sales is part of a profit for the year, computing profit for the year. So it would also go to the group retained what? Earnings. Because
Earnings.
it is wholly for the parent. It is not divided. Whatever belongs to the parent directly would not be broken down to parent interest and non-controlling interest, right?
Okay.
But look here now. If the subsidiary sells to the parent, it means the subsidiary has the profit and the parent has the inventory, right?
Yes.
I'll go to the parent and remove the what? The
Inventory.
inventory. Now you can see here. Here too, here also it said the subsidiary had the inventory. This inventory was removed from subsidiary and this from the parent, but you can see no difference. Why no difference? Because when consolidating, we add the inventory. So there is no need to say I'm removing this from where or this from where, right? Because the inventories are usually added. We said on consolidation, we add the assets, right? So the issue comes to equity.
Okay.
On equity, I would say the subsidiary got the profit. So I'm going to remove this profit from the what? The subsidiary. In the income statement, I would also say debit cost of what? Of sales, just as usual.
Of sales.
But when you go to the point of attributing them, when you go and start attributing them, I would say this was held by what? By the subsidiary. Whatever is the profit of the subsidiary or the equity of the subsidiary, usually the equity of the subsidiary should be broken down to the parent and to the what? Non-controlling interest. This
Non-controlling.
will be divided, but of course, as of now, like I told you, don't worry about it. Let's just go back. Let's just speak of what? Of the equity. Now remember, this,
Okay.
this relates to the profit of the subsidiary. And so it relates to the retained earnings of the subsidiary, right?
Okay.
Retained earnings is part of equity. Am I wrong?
No, you are not.
Okay. Since that means that equity is per working number 2, computes net asset at the acquisition and the reporting, and then the difference is divided like you saw. We divide it, right? Partly to parent
Yes.
interest and partly to NCI. And since now it would be belonging to the subsidiary, we have to break it down. Remember, the subsidiary has been bought by the parent, and the parent claims, let's say it's 80% that it has purchased there, right? So when you
Yes.
have something like this, it means I'm going to break this down into, right, into what? I'm going to say that it should be partly to NCI and partly to the group retained what? Earnings based on that percentage. You see that? So our main point here is If the profit is for the subsidiary, it must be divided. But if it is for the parent, it won't be divided. It would go directly to the group or parent interest.
Okay.
And this is what
Okay.
quantitation all entails, right?
Okay.
Yes. So you'll be done with that thing. And maybe let's try to speak about between the parent. Of course, I don't like to say the parent, you know, like I told you, an associate is dealt like something outside of the group. Let me just write a group and the associate, right?
Yes.
I do not say parent or subsidiary, whatever is in the group. And what? The associate. I think this would be better writing it this way. So now we are speaking
Okay.
of exactly the same thing again, right? Let's say now the group sells. The group does what? Sells
Yes.
to what? An associate. And then it would say, let's say it's an associate that sells to what? To the group.
The group.
What would happen in this case? If the group sells to an associate, it means the group would be having the profit and the associate would be having the what? The inventory.
Inventory.
You see that? So if the group
Yes.
has the profit, obviously the group is going to eliminate that profit, right?
Yes.
The associate is having the inventory. You cannot say you expect the associate to remove the inventory, but that inventory is not there. We said an associate is not consolidated. We use equity accounting. So you won't see an asset of the associate. You see that? So that's why
Yes.
in that case we resort to this point. Look here. We say, look here, if the associate is a purchaser, it means if the group is a seller, in other words, right? The group with
Yes.
the seller. You
The
see,
sale.
the associate is purchaser, so the associate has inventory, but you cannot say credit inventory because inventory of the associate will not be visible in the group because it is not consolidated. That's why what will be having the investment in the associate. The investment the company made in the what? In the associate. So that's why you
The
credit
associate.
investment in what? In your associate. Even if you do forget this, you don't have to come and memorize. Say, okay, this is what I would have done. But I usually don't have the inventor of the associate because I do not consolidate the what? The associate. So obviously what I do have is the investment in the associate. The working of which we are dealing with just not so far. You see here, investment in the associate. We are dealing with this thing here, right?
Okay.
Yes, so you're going to get it that way and wait. So the group sold the good. So if the group sold the good, the group has the profit. If the group has the profit, it's simple. I'm going to remove it from the group, so I'll debit cost of sales. You know why we use cost of sales? We are dealing with inventory here, right? And since we're dealing
Yes.
with inventory, cost of sales is equals to opening inventory plus purchase minus closing inventory. So that's why you like to adjust in the line item of cost of sales. I hope you can get why you
Okay.
do that now. Yes.
Yes.
And then we deal with the retained. Of course, it's not to go to cost of sales, it will also go to retained earnings. And here we deal with it as a group. Like I told you, it is a group between the group and the what and the associate. And that's why you could see something like that. You could say debit, group retained earnings, and credit investment in what? In a associate, right?
Association.
Yes.
Associate.
And now an associate sells to the group. If an associate sells to the group, it means the associate will be having profit and the group will be having inventory. Is it wrong?
No, it's not.
So I'm going to remove inventory from the group, and it is very possible because the group actually its asset will have been consolidated. Its inventory will be actually there, right? That's why you say credit.
Yes.
It's possible. Even here, you wanted to do, but there is no investment in inventory of associates, right?
Yes.
And now the associate sells, so the associate has a profit. So you have to reduce the profit of what? Of an associate. That's what you can see here now, right? Look here. If an associate is the seller, we did this. Credit inventory because inventory is being had by the group and it is there. And so remove the profit of the associate. we can't go to cost of sales because, like I told you, we do not consolidate the associate. We only take its profit, right? So that's why you can see here. Of course, for share of associates profit, you can leave it because, like I told you, we didn't do this income statement, right? But what we can know is
Okay.
I'm going to remove the profit of what? An associate. So to remove, if
Associate.
I reduce the profit of an associate, it means I'm going to reduce the retained earnings, right? That's what you can see here.
Okay.
Reduce the retained what?
Yeah.
Earnings.
Earnings.
And whatever equity that is related to what? An associate, we said you deal with it in the group retained group what? Group reserves, right? That's why
Okay.
this group retained earnings would be that we just come here and say debit what? Group retained what? Retained earnings.
Earnings.
Don't worry about this. When dealing with this, yeah, you cannot say that you're dealing this and then you go for the exam. No, we have to speak. You just need to understand why you do this. Right. Okay. We are
Okay.
doing this. This is because of this. We are doing this because of what? Of this. But when we are actually solving, I think you will get much more. Right. You'll say, okay, so we did
Okay.
because of this. Yes. So as of not said, because can you say consolidation? Whatever I do, I have to. You could say, okay, whatever.
Okay.
So this is dangerous. No, you have to do this because you have to understand what is going on. Right.
Yes.
I'm telling you, if you understand what is going on, you better use 4 hours to do something and understand. Because as time goes
Yes.
on, it will be simpler and simpler. If you don't understand on consolidation, the same question you could struggle with the same question 5 times. I'm telling you.
Okay.
Yes, but if you do
Yes.
understand, everything would get better. Yes. So don't worry about this. Just get
Okay.
a picture and something like that.
Okay.
Okay, so I think for this normal adjustment, I think you've done enough. Maybe
Okay.
I was thinking of something. There's that issue of cash in transit and goods in transit. I wish about you know, I want you to go through this, do this question.
Ah, you've gone.
Okay, can you hear me now?
Yes, now I can hear you.
This question on associate, it wants you to extract the statement of financial position and the profit or loss. But for profit or loss, we left it first, right? We didn't deal with the
Yes.
maybe you could only try that one for financial position, and don't worry at all. Maybe where you're going to end, it's fine. It's very fine. I just need you to have a glimpse of
Okay.
it because in an exam, you're going to encounter a fully stacked question, right? And
Okay.
actually, you would find it very simple when you just go on. There are two things which remain, and I don't want to go very far in them because we're going.
Okay.
I will try to stage them in the exams, right? In the question. This cash in trans,
Okay.
I'll just pick normal of it. This question here,
Okay.
this is the question of the statement of financial position we'll deal with. I will try to adjust. I'll add some notes so that we can find it here, right? You see, we are told there
Okay.
are group payables or receivables. I'm going to change this. There could be intragroup payables or what? Receivables. A parent has sold goods, let's say for 600 to a subsidiary, but maybe a subsidiary, maybe at 3 days before the closure of the year, the subsidiary paid it 200. You see? So when the year was being closed, the parent didn't know the subsidiary had paid, so it had adjusted its books already, right?
Okay.
Had yet to receive, so the parent didn't know. So the parent, first of all, it has to act as if it has received the goods and it has to change, it has to adjust. And then what remains and then balances will also have to be eliminated. So we'll see how to do that. But I think I'll incorporate it here, right? So what
Okay.
you need to understand is you should always expect cash in transit, but also goods in what? In transit. When we
In
say
transit.
when you say cash in transit, it means the buyer has paid, right? The buyer has paid,
Yes.
adjusted its books, but the seller is yet to receive that amount, right?
That amount.
Seller has
Yes, sir.
very simple. It means the seller has not what? Recognized the cash, right?
Has not received.
Yes.
Yes.
So has not received, and so it has not recognized. So what we do, we just presume, okay, what amount was sent? 200,000, right? Or 200, just 200, 200.
Yes.
So the parent, whatever, whether the parent or the subsidiary would say, okay, so 200 have been sent and I haven't received. You presume as if you have received, right? So I would say debit the cash.
Yes.
Cash in what? In transit, right? The cash. Let's
Yes.
say by how much? By 200. Okay. By doing this, it means it has sold the goods on credit, let's say, right? So it had the trade
Yes.
receivables. So since it presumes to have collected the cash, it also has to reduce the amount of the trade what? Receive.
Receivables.
Simple with that by 200. See that? So that is simply the cash in what? In transit.
In transit.
This video of mine on cash in transit, someone went through the channel. It was like 2 days ago, and he said that okay, this thing was giving me a lot of problem. They had memorized, I think. I wonder, I see my that guy. I went to like say, I actually see myself as a fool. It is something this simple, but I never knew. I never knew how to go through it because I was memorizing. You can see there's a video written cash in transit. I'll share with you that video on cash in transit, and I think it is the best moment. It's
Okay.
like 4 minutes, and there is the question that I used both cash in transit and the goods in transit in one question. So I think it's time I'll be trying to share those short clips. Right. So
Okay. Okay.
doing this, you would expect the maybe the trade receivable was 1,000. If you deduct 200, it would be 800. You would find that the trade receivables on the seller is equal to the trade payables on the what? On the buyer, and so you just go and eliminate them, right?
Okay.
Let intra what? Intra group. You can just say and then eliminate intra what? Intra group, right? Okay.
Intragroup.
Let,
Okay.
let's now speak of the goods in transit a bit, just a bit. I just need you to understand to get a picture. Goods in transit is like the goods in transit is someone has sold, right? And the goods have been dispatched. If you sell the goods and you dispatch the goods, of course, you record in your books, right? Okay, maybe
Yes.
what is the books fee? I've debited the trade receivable, someone else to pay me. But the bad thing is the buyer has not received the goods. So the buyer won't deem, if they purchased on credit, they won't deem themselves actually liable for paying, right? So
Yes.
this happens near to the end of the period. So when the period is closed and someone doesn't have any information, so what we do is we presume as if we have received the goods, right?
Okay.
If you say that you have received the goods, you say like maybe you have debited, you could say maybe debit purchases. Debit what?
Purchases
Of course, if you're preparing the income statement, this purchase would obviously go to cost of what? Cost
of
of,
sales.
but also maybe,
Of sale.
of course, but remember, we can remember this would be the period would have ended in the goods are on right, have not reached. So we could just say that these are the closing inventory. They would be part of the closing what? Inventory. I wanted to give you
Inventory.
this, but this one would be the inventory. Let me just write here inventory. So I had to start from there so that to get the point of what I mean, right? Inventory, right?
Inventory.
So I'll just write this one for memorandum purpose. I just need you to get the picture. Inventory,
Okay.
and I would say, okay, these goods are on credit. I'm yet to pay. So I would say trade what? Trade payables.
Trade, payables.
So you could see trade payables would also go up. at this point, everything would be
Okay.
fine, and you could now eliminate the intragroup what balances. The point to note on goods in transit. The point not on goods in what? In transit is this. Remember, all of these goods they have not even reached. So they will have provision for unrealized what?
Profit.
You remember on provision for unrealized profit. It is the goods which have been sold between the group and they have not yet gone out of the group. Remember, even the receiver has not yet
Yes.
got the goods. So they are obviously a provision for the profit. And you don't even need to know the percentage because all of the profit is yet to get out of the group. Right. So remember,
Yes.
whenever you deal with the goods in transit, you would have to adjust for the provision for unrealized what? Profit. Right.
Profit.
Yes. I think this is fine now.